this new revenue standard, it's a new way of thinking. And it's a comprehensive overhaul of the revenue guidance that we've all come to know. And what that means is previous decisions, conclusions that you've reached, and all the industry consensus that has been formed over the last several decades around how to account and how to present revenue, they're really out, they go out the window because there's a new way of thinking now. So understandably, when the new standard was issued, there was a lot of uncertainty, anxiety around what's going to be the impact on companies' reported results. And as people started digging in, what's the impact to the accounting profession and a lot of the judgments that need to be made? It's moving from a rules-based approach to a more principles-based standard. So that means there's harder judgments and potentially judgments that could be questioned. There are two developments, I think, that have really eased the transition from an accounting perspective for companies that prepare financial statements and for the accounting firms. The first is that the FASB set up a transition resource group, or a TRG. And this is a public mechanism to talk about the difficult implementation issues. And the meeting materials and the minutes for these meetings that were held between 2015 and 2016 provide a lot of color and context around what did the FASB mean when they wrote those words. Provides a lot of examples, and a lot of times where there was maybe multiple possible outcomes, the TRG paper will say this path is not acceptable, and that really helped narrow down the choices that companies would need to be making in some of the judgments. The second development I think has really helped is that the AICPA set up industry task forces, 16 industry task forces. So aerospace and defense, asset managers, software, they all get their own industry task force. And the purpose was to try to take these industry nuances and the business models that are very specific to different industries and to try to fit those and translate those into the 5 steps that Jason and Hal just showed. Because it's a single generic model, but every industry is different. And so these task forces issued about 150 white papers that go through how to apply the revenue model for various industry transactions. And if you're following a particular industry, these are a great resource to try to figure out what's the impact, what's the change from yesterday's accounting to tomorrow's accounting. So there's a wealth of information out there to help preparers and the accounting profession, but I think that consistency of outcomes is elusive, and I think it's unrealistic that companies will all align and have similar accounting under this new revenue standard. And the main reason is that there's a lot of principles, a lot of judgment involved, but also that there's a lot of places where there's no binary answer, yes, no answer on how to account for it, and every contract is structured differently. So you're looking at companies, you're going to see differences in how companies account for things, and hopefully it comes out of the disclosures, some of the judgments to help you compare. So let's spend a minute on where companies are in the process. So the FASB allowed for early adoption, and starting 1/1/17. Not a lot of companies took the FASB up on that offer. We looked at the Fortune 1000 recently and saw that only about 20 public companies early adopted the standard last year. And so this was, some of these are household names. Ford, Microsoft, Google, Apple applied the new standard, but really the vast majority are waiting until the mandatory effective date, which is 2018 for public companies. For the companies that haven't adopted yet, looking at what we call the SAB 74 disclosures, it's an SEC requirement in Form 10Q filings to say, what's the expected impact of new accounting standards? And so from the Q3 to 2017 filings, we saw that about more than 50% of public companies believe that the new revenue standard will not have a material impact on the financial statements. Now, a lot of work goes in because it's a new framework to reach that conclusion, but ultimately more than half of public companies are saying not a material impact on the financials. Well, the companies that do think it's material, only about 10% so far have actually quantified what that impact is, but I expect when we start seeing 12/31/17 10Ks come out that number will go up. So we're going to pivot here and talk about some of the challenges, the top areas where we're receiving questions from companies and applying the new model. I'll highlight a couple. And the first is gross versus net revenue presentation. And this is what accountants call the principal versus agent analysis. So I'll use an example. And let's say that I'm providing services to Greg, my customer. But in order to provide those services, I need help. And I need to delegate to a third party and say, Jason, I'm hiring Jason and I'm delegating some of the work out, farming it out to him. So when I get revenues and I get cash from Greg, my customer, what do? Do I record the full revenue that he gives me? And then I record an expense for what I pay to a third party, Jason, in order to help me perform that service? Do I do a gross approach? Or do I just report net revenue for the revenue that I get to keep and retain? This has always been a really difficult accounting issue. And it's because GAAP does not provide a yes or no answer on gross versus net. What's the right answer? It gives indicators that you should consider. For instance, who's responsible for the service? Who sets the price? Am I responsible for setting the price, or is the third party responsible? Who has the credit risk? Is it me or the third party? Now, because of the indicators and not a lack of clear guidance on how much you're supposed to weigh each of the indicators, there's differences today in practice. Some companies have similar transactions, and some go gross and some go net. What I'm seeing is that will continue under the new standard. The new standard also has indicators, does not have a binary yes or no on whether to report revenue gross or net. The indicator is slightly changed, though, compared to what was in current practice. So as a result, any company that's providing goods or services and that uses third parties to help deliver those services, it really has to revisit their gross versus net conclusion. And so we're getting a lot of questions from companies because it's really impactful to their income statement. I mean, the new revenue standard, it could accelerate or delay revenue here and there, but I think that pales in comparison to the impact that all of a sudden you're moving from net reporting to gross reporting, or vice versa. So we're getting a lot of questions. People don't want to get second guessed in their judgments around how to weigh the various indicators. Another point I'll highlight is the third item here, and it's a variable consideration. And this is a bit of a change from the current accounting landscape. And I'll use an example. So let's say I have been hired to construct a building. And I'm going to get paid $1 million to build it. But if I finish the building early, then I get a performance bonus. And let's just say I get $200,000 performance bonus. Today's accounting will basically dictate, because there's guidance around it has to be fixed and determinable to book revenue. Well, so I'll book the $1 million throughout the term, and then I'm going to wait and book that $200,000 at the end only if I earn it, only if I actually finish it early. But under today's model, the new model, what I'm going to do is I'm going to take that full $1.2 million, the fixed piece and the $200,000 that I might get. It's a variable consideration. And if I'm comfortable that I'm going to finish the project early and earn that performance bonus, then I'm going to spread that $1.2 million evenly over the contract. That accelerates revenue compared to today. And the reason this is a challenge is it's very hard for a company to justify that the probability that they're going to get that performance bonus. And there's a lot of difficult judgments that they have to make and the auditors have to get comfortable with. But it's going to potentially lead to acceleration of revenue in some situations, but there's a high hurdle in order to get there. It's a really difficult accounting judgment to make.